We invest in companies because we think that they are great stocks to be shareholders of and they have great value. But how do we come to the conclusion that they have great value? Well, there's some research that goes behind the scenes which is called fundamental analysis, which helps us analyze a company's metrics and conclude that yes, this company has great value and they have great long-term potential as well. And usually what the kind of things that you look at in fundamental analysis are how much revenue a company makes every year, what is their growth look like, how many people are they hiring, what are the business verticals that they are a part of, what is their profit like, what are the new sort of things that they have done in the market. Another thing is what is the market sentiment, what do people think about the company, because essentially the company's stock will only rise if more and more people buy it. So this entire research is called fundamental analysis, where we look at all of these metrics. But when it comes to crypto, the collection of all these metrics is very different. You're not looking at things like profit or things like growth in the same way that you look at it as for companies. The fundamental analysis of cryptocurrency has a very important concept called tokenomics, which everyone needs to understand if they want to understand whether the crypto that they want to buy is well priced, well valued or not. So tokenomics is essentially a collection of all the economic factors or economic features of a cryptocurrency that make it attractive for investors. It's essentially how the tokens are distributed, how they're priced, how they're used. Collection of those metrics is called tokenomics. Now there are 4 factors in every tokenomics study. The first one is allocation and distribution of the token. The second one is the supply of the token. The third one is the market capitalization. And the fourth one is the token model. Any good tokenomics study should consist of all of these 4 factors and you should really critically analyze them. So let's look at each of them briefly and then we sort of deep dive into them as we go along. So the first and one of the most crucial factors in tokenomics is the allocation and the distribution of the token. So think of allocation and distribution of a token similarly to the shareholding pattern of a company. So when you compare tokenomics to the shareholding pattern of the company, essentially you're looking at who owns how much of a particular token. It's commonly known that if one shareholder owns too many shares of a company, then they get a disproportionate say in what happens in the company. They get to overrule a lot of the decisions that someone else makes, and they basically have a lot of power, which might be a bad thing for the company's future. In the same way, if someone holds too much of a crypto token, then they have undue advantage on the market price of that crypto. Someone sitting in Barbados might have 20% of the cryptocurrency that you want to buy, and if that person doesn't have the right intentions, you're in trouble because they could dump the 20% and that'll lead to a huge decrease in price overnight. So essentially that's why the distribution is super important. If someone has tons of a particular token, if they have like 20-30% of the entire supply of the token, they can manipulate the price at will. So you need to be careful about which token you're trying to get into and what's the allocation and distribution of it. We've covered the distribution aspect, we'll go on to the allocation aspect, but one key thing to remember is that this data of who owns what percentage of a coin is readily available for most popular crypto projects, and we'll tell you how to actually research that as well. But for now, you need to know that this is a metric that you absolutely need to have on your checklist to figure out whether you should be invested in a particular coin or not. The allocation of a cryptocurrency can be done in 2 ways. One is fair launch and the other one is pre-mine. So Bitcoin was a fair launch allocation, and whereas a lot of new cryptocurrencies that come up today are pre-mined. What is the difference? In a fair launch, there is no access given to the early investors or the founders differently than the community. So essentially a fair launch project is where crypto is mined, earned, used for within the community itself. There's no special treatment that's given to anyone. Versus in a pre-mine, what happens is that the early founding members of the team pre-mine some of the coins and give early access to founders, early investors, and some early parts of the community, early members of the community. So obviously a fair launch is better than a pre-mine because there's no special treatment given to anyone. Everyone has the sort of same level of access to the supply of the cryptocurrency. But that said, that a lot of crypto projects today are pre-mine, and you shouldn't dismiss a project just because it's pre-mine. Essentially, what you should check for is just the distribution. If there's anyone who's holding a ton of crypto, and especially if it's like the founders or the early investors, then you might want to think about what their intentions are, because they could very easily collude and create like a pump and dump scenario where your retail money is at risk. Understanding the supply of a crypto project is very easy, because just think of it the same way you think of as the supply for our fiat currencies today. So this is a popularly known fact that because of the Fed printing a lot of fiat currency, a lot of dollars basically, the value of one single dollar kept reducing. Essentially, it's the same as inflation. Inflation leads to a decrease in the purchasing power of money, mostly caused by a rise in the supply of money. So the same way, if the supply of a cryptocurrency can very easily be increased, then you should know that your crypto might not hold the same value that it does today, because every new unit that's put out in the market will reduce the price of every existing unit. This is why Bitcoin is like a total winner, right? Because they have a capped supply of 21 million Bitcoin. So it can never be possible that the price of one Bitcoin will reduce from here. As in, it's very unlikely, because the supply is never going to increase. Every Bitcoin today will keep gaining more and more value, because it keeps becoming scarcer and scarcer by the day. So the next thing is the token model, which is pretty important. Now, broadly, there are two types of token models: inflationary and deflationary. Super easy to understand. Inflationary token models are of crypto projects that will continuously keep producing tokens through some action or another. And deflationary is the exact opposite. Bitcoin is like a deflationary token model, because you can never produce more of it. So obviously, it'll be fairly simple by this point to understand that a deflationary token model will mean that the currency will usually rise in per unit price. It's not to say that either of the token models are bad or good, but it's just a thing that you need to understand about supply and demand. There are also some cryptocurrencies with dual token models, where they have two tokens and one might be inflationary, the other might be deflationary. This is essentially, again, just to control supply and demand. The token model is important because it gives you a window into what's the thought that's gone behind into creating the asset, and how you can basically leverage that to create a thesis. So it depends on whether you want to stick to just deflationary tokens or you are open to inflationary tokens, but it gives you a window into what the supply of the token might look like and what could happen to the future price. And that's why it's important to understand the token model. So the market capitalization is very similar to how market capitalization is in stocks. It's essentially the circulating supply into the price today. That's equal to the market capitalization. You're basically getting a measure of how many people have invested how much in the crypto asset. It's a great measure of legitimacy, because a high market cap cannot be achieved unless a lot of people have put a lot of money into a crypto project. And that's how crypto assets are divided. You have blue chip cryptos like Bitcoin, Ethereum, and a few others that have high market caps, and then you have mid caps and low caps. Usually your risk will increase as you go down the ladder. So blue chips will have lesser risk, low caps might even not be legitimate projects. And that's how essentially you're supposed to think about market cap of cryptos.